Here are two Australians. The first is Sarah. She's 31, works full-time as a nurse in Adelaide, earns $92,000 a year. Every fortnight, she opens her payslip, sees the PAYG withholding line, and quietly accepts that a chunk of what she earned has already left. At the end of the financial year, she lodges her tax return, claims her uniform, her laundry, her union fees. She gets a refund of about $800 and thinks she did all right. Her effective tax rate, when you do the maths, is roughly 23%. The second is Tom. He's 52, lives in Sydney, owns 2 investment properties and a share portfolio. His gross income across all sources is over $500,000 a year. But Tom has a good accountant. His properties are negatively geared, so the rental losses offset his other income. His shares pay franked dividends, so he gets credits for tax the company's already paid. Some of his income flows through a family trust, distributed to his wife, who earns less. His effective tax rate, when you do the maths, is about 11%. Sarah pays 23, Tom pays 11. Australia's tax system is called progressive. It's designed on paper to charge you more as you earn more. And yet, here we are. A nurse who earns under $100,000 is paying roughly double the effective rate of an investor earning 5 times her salary. Both are following the law. Both are paying exactly what the system asks them to pay. The system just asks them very different things. That's not a glitch. That's the architecture. And this video is going to explain how it works, piece by piece, until you can see it for yourself. Now, before we go any further, I need to say something. This isn't a video about tax tricks or loopholes. It's not about how to pay less. It's about understanding how the system actually works, who it was built for, and what just changed in the biggest federal budget reform in a generation. Because the government just tried to fix this. Whether they succeeded is a different question. But you can't judge the answer until you understand the problem. So here are the 2 questions this video answers. First, if Australia's tax system is designed to charge the rich more, why does a nurse in Adelaide pay a higher effective rate than a property investor in Sydney? And second, if the government just announced the biggest tax reform in decades to fix exactly that, did they actually fix it? Let's start with how the system is supposed to work. Australia uses what's called a progressive tax system. That word, progressive, just means the rate goes up as your income goes up. You don't pay one flat rate on everything. You pay different rates on different slices. Picture Priya. She's 24, just landed her first full-time job as a junior analyst in Melbourne, earning $65,000 a year. She looks at her payslip and thinks the government's taking 30% of everything. But that's not how it works. Not even close. The first $18,200 Priya earns is completely tax-free. 0. The next slice, from $18,201 up to $45,000, is taxed at 16%. Then, the slice from $45,001 up to $135,000 is taxed at 30%. There are higher brackets above that, 37% and 45%. But Priya doesn't reach them. So even though Priya's top marginal rate is 30%, her effective rate, the actual percentage of her total income that goes to tax, is much lower. Roughly 15% after the low income tax offset. That's the gap between marginal and effective. And it's the most important concept in tax that nobody teaches you. I'm going to be honest. The first time someone explained marginal rates to me, I had to draw it on paper 3 times before it clicked. It's one of those things that's simple once you see it but feels deliberately confusing until then. Here's the analogy that finally made it stick. Think of your income as water filling a series of buckets stacked from the ground up. The first bucket holds 18,200 liters. Water fills it for free. The second bucket holds everything up to 45,000. You pay 16 cents for every liter that goes in. The third holds up to $135,000 at 30 cents per litre. The buckets fill from the bottom up. Your income doesn't jump to the top. It rises gradually. And you only ever pay the rate on the water that's actually in that bucket. That's the principle. And on its own, it's genuinely elegant. The structure of progressive taxation is, in principle, one of the fairest ideas a society can build. The problem is what happens next. Because on top of your income tax, you pay the Medicare levy. That's 2% of your taxable income, flat, funding the public health system. If you earn above the threshold and don't have private health insurance, there's an additional Medicare levy surcharge of 1 to 1.5%. Then, if you have a HECS help debt from uni, there's a compulsory repayment that gets taken out of your pay once your income crosses $67,000. Priya, our junior analyst, has all three: income tax, Medicare levy, and HECS repayment. By the time she works out what she actually takes home, the number is a lot further from $65,000 than she expected. She looks at her payslip every fortnight and feels like the system is taking a bigger bite than it should. And she's right to feel that way, because the system does take a bigger bite from people like her, proportionally, than it does from people like Tom. Now here's where it gets actually interesting. Stay with me, because this next part is where most videos lose people. We're not going to. The tax system doesn't just have brackets, it has doors, and those doors lead to lower effective rates. But they only open for certain kinds of income. The first door is deductions. Everyone gets deductions, right? Sarah, the nurse, deducts her uniform, her laundry, her continuing education, maybe $2,000 or $3,000 total. That reduces her taxable income by that amount, which saves her about $600 to $900 in tax. That's something. It's not nothing, but it's not much. Now picture Liam. He's 38, a tradie in Perth, earning $120,000 with overtime. His marginal rate is 30%. If Liam bought a ute for work, and it qualifies under the instant asset write-off, he might deduct tens of thousands in a single year. If he salary sacrifices into super, he moves income from his 30% marginal rate into super's 15% tax environment. Deductions scale. The more you earn, the more each dollar of deduction is worth. A $1,000 deduction saves $160 for someone on the 16% bracket. The same deduction saves $300 for someone on 30% and $450 for someone on 45%. Same deduction. Same system. Very different outcome. That's the first door. Here's the second. Capital gains tax. When you buy an asset, say a property or shares, and sell it later for a profit, that profit is called a capital gain. In Australia, if you've held that asset for more than 12 months, you get a 50% discount. Half the gain is simply not taxed. This is massive when you do the maths. Let's say Tom, our Sydney investor, sells a property he bought 10 years ago for $500,000. It's now worth $900,000. That's a $400,000 gain. Without the discount, that entire gain would be added to his income and taxed at his marginal rate. With the discount, only $200,000 is added. At a marginal rate of 45%, that discount just saved him $90,000 in tax. $90,000. On a single sale. Now here's the question nobody asks. Sarah the nurse doesn't have capital gains. She earns salary. Salary doesn't get a 50% discount. Salary goes straight into the brackets, every dollar, no exception. Two people, same amount of money, one pays tax on all of it, the other pays tax on half. That's wild when you think about it. Third door, negative gearing. This one's uniquely Australian, and it confuses almost everyone. Here's how it works. If you own an investment property and the costs of that property, your mortgage interest, your council rates, your insurance, your maintenance, are more than the rental income you receive, you're running at a loss. That loss, in Australia, could be deducted against your other income. Not just your rental income, your salary, your business income, everything. So Tom, our investor, is deliberately losing money on rent. Every year, he declares a loss of, say, $25,000 on his properties. That loss reduces his taxable income by $25,000. At a marginal rate of 45%, that saves him over $11,000 in tax every year for losing money on purpose. And the whole time, his properties are going up in value. When he eventually sells, he gets the 50% CGT discount on the gain. Lose money now, save on tax, gain on the asset, pay half tax later. That's the loop. That's the door salary earners can't walk through. Honestly, this is the part where I wanted to give up and make a cooking channel. But it gets even more layered. Fourth door, franking credits, also known as dividend imputation. This is a system that's almost unique to Australia. When an Australian company earns a profit, it pays company tax at 25 or 30%. When it distributes that profit to shareholders as a dividend, the tax the company already paid comes with it as a credit. So if Tom receives $10,000 in fully franked dividends, the company already paid about $4,300 in tax. Tom includes the full $14,300 in his income, calculates the tax, and then subtracts the $4,300 as a credit. If his marginal rate is lower than the company tax rate, he gets a refund on tax he never personally paid. The system was designed to avoid double taxation. In practice, it means shareholders in profitable companies pay very little additional tax on dividends, and some pay none at all. Fifth door, discretionary trusts. A family trust allows income to be distributed to different family members. If Tom's trust earns $200,000 and distributes half to his wife, who has no other income, her half is taxed at her lower marginal rate, starting from the tax-free threshold. The income hasn't changed. The family hasn't changed. But the tax bill just dropped dramatically. Now here's the reveal. Zoom out. Sarah earns salary. Every dollar goes through the progressive brackets. No discount, no offset against losses, no credit for someone else's tax. No trust to split it through. Her income enters the system, and the system takes its share. Tom earns investment income. Capital gains get halved. Rental losses get deducted against everything. Dividends come with credits. Trust distributions go to the lowest rate family member. His income enters the system, and the system opens every door. Same country, same tax code. Two completely different systems sitting inside one. One for people who earn wages, one for people who own assets. And the progressive brackets, the ones that are supposed to make the rich pay more, only fully apply to the first group. That's the paradox. The system says it charges more as you earn more. But the system also says that not all income is treated equally. And once you see that, you can't unsee it. I know. I had the same reaction. There's a whole universe of self-managed superfund tax strategy and Division 7A rules that I'm not dragging you into today. If you want that, you need an accountant and a very strong coffee. What matters here is the structural picture, and the structural picture just changed. On the 12th of May, 2026, the federal government announced the biggest tax reform package in a generation. Three things happened. First, negative gearing for established residential property was limited to new builds, starting from the 2027-2028 financial year. If you bought your investment property before the announcement date, nothing changes. You're grandfathered. But from now on, if you buy an existing house to negatively gear, you can only offset those losses against other rental income or property gains, not against your salary, not against your business income. That door, for established property, starts closing. Second, the 50% CGT discount is being replaced. From the 1st of July 2027, instead of automatically halving your capital gain, the system will adjust your cost base for inflation and then apply a minimum 30% tax on the real gain. For some assets, this means a higher tax bill. For others held a very long time with high inflation, it might mean a lower one. But the blanket 50% discount, the one that saved Tom $90,000 on a single sale, is going away for gains that accrue after that date. Third, discretionary trusts will face a minimum 30% tax from the 1st of July 2028. The trustee pays at least 30% on the trust's taxable income. Beneficiaries get a credit for what was paid. But the strategy of distributing income to a family member on a zero or low marginal rate to dramatically cut the family tax bill just got a lot more expensive. Quick pause. Let that sink in. These are not small changes. They're structural. They attack the exact mechanisms that create the gap between Sarah's 23% and Tom's 11%. But here's why the paradox doesn't fully resolve. These changes are prospective, not retrospective. Every property bought before the announcement is grandfathered for negative gearing. Every capital gain that accrued before July 2027 keeps the 50% discount. Every trust has until 2028 to restructure. The doors aren't being slammed shut, they're being slowly narrowed. People who already walked through them keep their advantage. People who haven't yet will find it harder. And salary earners? Their income still goes straight into the brackets. No discount, no deferral, no offset. The playing field is more level than it was a month ago, but it isn't level. Every situation is different. What you've just learned is the framework, not the answer for your specific circumstances. Now, the mistakes almost everyone makes. The first one is thinking you pay your marginal rate on everything. You don't. If you earn $100,000, you're in the 30% bracket, but your effective rate is about 22%. Those are wildly different numbers, and understanding the gap changes how you think about overtime, a raise, or a second job. The second one is thinking a big tax refund means you won. It doesn't. A big refund usually means you had too much withheld during the year. You lent the government your money, interest-free, for 12 months. A perfect tax outcome is a refund of close to zero because you had the right amount withheld and used your money all year. The third one is thinking the new budget reforms fix the structural gap. They narrow it significantly. But as long as different types of income are taxed at different effective rates, the gap exists. Knowing that doesn't make you cynical. It makes you informed. So what do you actually do with this? First, calculate your effective tax rate. Open MyGov. Look at your last tax assessment. Divide the total tax assessed by your total taxable income. That number is your real rate, not your marginal rate, your real one. Most Australians have never done this, and the number is almost always lower than they think. Second, understand that deductions work at your marginal rate. If you're on 30% and you have $1,000 in deductions you're not claiming, that's $300 in tax you're paying for no reason, every year, for your entire working life. Third, if you have a HECS help debt, know that the system changed. Repayments are now marginal, not cliff-based. You're not suddenly hit with a massive repayment at the threshold. And indexation this year was 2.8%. That's much better than the 7.1% shock a few years ago, but it's still growth on a debt you might not be thinking about. Fourth, look at your super. The concessional contributions cap is $30,000 a year. If you're not salary sacrificing into super, every dollar you contribute is taxed at 15% inside super instead of whatever your marginal rate is outside it. For someone on the 30% bracket, that's a 15% saving on every dollar. If you haven't contributed up to the cap in previous years and your total super balance is under $500,000, you can carry forward unused cap from the last 5 years. That's a powerful tool, and almost nobody uses it. If you want a solid, Australian-specific starting point for all of this, the Barefoot Investor is still one of the best frameworks out there. And if you want to check your own super, your HECS balance, or your tax situation, log into MyGov. It's all there. It's just not explained. Here's what this comes down to. The Australian tax system is progressive in its brackets and regressive in its architecture. The brackets say the more you earn, the more you pay. The architecture says the more you own, the more doors you can open. Both are true. Both are the law. And the gap between them is where the real story lives. If you came into this video thinking tax was just the number on your payslip, I hope it looks different now. Not scarier, just clearer. Because clear is the beginning of useful. 3 things to take with you. 1. Your marginal rate is not your effective rate, and knowing the difference changes every financial decision you make. 2. The tax system treats salary income and investment income completely differently, and that structural gap is why a nurse can pay a higher effective rate than a millionaire. 3. The 2026 budget tried to close that gap. It narrowed some of the widest doors, but the paradox doesn't disappear until all income is treated equally, and whether that ever happens is a question bigger than any single budget. Most Australians will work for 40 years and never once calculate their effective tax rate. If you just did, even roughly, in your head, you're already ahead. And if you're now the person in your family who can explain why your payslip looks the way it does, that conversation matters more than you think. Remember Sarah and Tom from the beginning? Same country, same tax code, 2 different outcomes. Now you know why. And now you know what just changed. What you do with that is up to you. But at least now, you actually see the system. This is general education, not personal financial advice. If you need advice tailored to your situation, speak to a licensed financial advisor.